Hi, welcome to the Market Alert for Thursday, the 20th of August 2015. Starting off slightly different this morning. I've received quite a few questions about which websites I actually look at to get the economic news that I put out in the Market Alerts, and the main one is Hedge. We've seen this in previous episodes of the Market Alert. And a brilliant website, no doubts about it. Alternative economic news, which is, in my opinion, is the real news. So you certainly don't get it in the mainstream. People tend to toe the lines of what their paymasters want, i.e. the Federal Reserve, Bank of England, that the economy is fine, the economic news is fine, and it's interpreted to make it look as if everything is fine, when in fact it isn't the case at all. And if you just do a bit of research, you will actually find this to be the case. Interesting that the economic crisis goes mainstream now, and I love the elephant in the room because I've been talking about this for years and written about it as well. Also, you get the truer picture of the FOMC meeting minutes, which we had last night, of course. We'll come to that in just a moment, the market's reaction on how it was interpreted, but you will see article after article that is posted during the trading day, giving you, I believe, the true perspective of what is actually going on. Here you can see this, the path to rate normalization. This is a word you're going to see a lot in the next few months, normalization. And what the Federal Reserve are trying to do is to normalize the market, make it look as if everything's fine, the economic news and the data is true, and that prices are rising, the economy is doing well, and with that they can raise interest rates to normalize the market after the $4 trillion that they've spent trying to create a normal market within the last 7 years. But you will see article after article, and again stocks soar into green as question emerges: rate hike or QE for first. So it seems now that again that there's going to be more talk about whether the Fed are going to actually print more money first or they're going to raise rates. And also you can see here there's confusion. Fed confusion is leaked in FOMC minutes. FOMC minutes leaked. You'll find them on this site. You won't find them on the BBC or Bloomberg. And there's just article after article. They're absolutely brilliant. If you want to know what's really going on, then this is the #1 site for economic news. Right, let's have a quick look at the markets and see what happened yesterday. We've got the 5-minute chart here. See the market taking out the 17,400 in the early part of the trading session, the morning session in New York. The market then trades sideways, and we can expect this really. You either get a lot of volatility on the day of the FOMC meeting in the first part of the session, and then nothing during the quieter part, and then the Fed's reaction, or you get what we had yesterday. You can see the market moving higher initially, and then the Fed statement coming out, and you see the market stopping and stalling at the 17,500 level. Back below the 450, we get the sell signal. This is the only signal that is valid because this one is before the announcement, so this one isn't taken into account. And there you see the market trading through the 17,400. It trades to it, comes back, but fails to close above the entry price. And because of the indecision in the background, the short side is still the best side until the Fed decide to print more money, and then you'll see a massive move to the upside, and you will see the market run out of steam when they do that as well. It'll do it for a while, and then it will turn and go south like it is now. It will never, ever, ever work. You cannot have government intervention in the markets where it will be sustained for the long term. It's just impossible. China is seeing that and witnessing that at the moment. It's a bit like giving an alcoholic more drink until eventually the effects become less and less, and you actually kill the individual. And that's going to be the same for the market as well. So what you get is, if you take up drinking and you haven't drunk for months, then the effect that you get is quite marked. But as the body adjusts to the drinking, i.e. QE, as in the stock market, then the results and the effects become less and less, and that's what we're starting to see. That's why the market has run out of steam. It's not because of economic growth, it's because the effects of QE and government printing has vanished, and now you're seeing what the market should really be like without it. And if they don't print, then the market and they raise rates, the market's going to go lower very fast, and that's what they're aware of. And if they do print, then you've only got this sort of last stand before the market then collapses as well. So interesting times. Never witnessed this in 20 plus years of trading. So we're now starting to see how an experiment, which it has been, a very expensive experiment of 4 trillion pumped into the markets to see how it could actually give the perception following the bank collapses that the economy is fine and everything is doing well, which is simply not the case at all when you actually look at the real figures. So the market moved lower and then eventually traded through. We see the selling down to the 17,350 level, and you will see that that sort of figure is around 77 points for the trade on the day, and then the market finding support, bouncing back, and then has come back once again and gone through this and traded lower. In the daily charts, you've got selling for the day. You can see when the market's going up, it's going up on fresh air. When it goes down, it's going down on selling. You can see all of the red bars here showing this. The green bars that you do get on the upside are short covering, i.e. people that have been selling to the downside are caught out, have to buy back, and that increases the buying to close the trade and brings the market slightly higher. But certainly selling to the downside there, the market's trying to move back to the upside again on the overnight market. In today's news, what have we got? 3 p.m. existing home sales and Philly Fed manufacturing index. You can see the previous in these. We've got a lower forecast from the previous in the home sales and 6.9 increase in the Philly Fed. The Philly Fed is the one to watch at 3 p.m. as manufacturing obviously is vital to real growth in the economy as opposed to services. So it'll be interesting to see how that one pans out at 3 p.m. there. And right, finally, the implied volatility, 1387 yesterday as the market declined following Yellen's statement, the FOMC statement at 7 p.m. So moving up slightly, and again, obviously some concern about the downside of this market. Right, that's it for me for this morning. I'll see you in tomorrow's edition of the Market Alert. As ever, thank you for your support and also for watching. See you in the next one.